Everyone's watching the price of Bitcoin and Ethereum, but they're missing the real story. They see a 5% drop and panic or a 10% pump and get euphoric. But what if I told you that these daily moves are just noise, just fleeting signals in a much larger, more powerful symphony of global economics and regulatory chess? In this video, I'm going to show you the hidden macroeconomic and regulatory shifts that are secretly driving the market. We're going to peel back the layers, look past the 1 hour chart, and decode the real forces at play. These are the tectonic plates moving beneath the surface, the things that truly determine whether we see a crushing bear market or a generational bull run. By the end of this deep dive, you won't be watching the hourly price wicks with anxiety anymore. You'll be watching the global money supply, you'll be watching the Federal Reserve, and you'll be watching the legislative bodies in Washington and Brussels, because that is where the real story is being written. We will connect the dots between trillions of dollars in global liquidity, the subtle language of central bankers, and the on-chain data that proves our thesis. So if you want to understand what's really driving your portfolio and what to expect for the remainder of this year and into 2026, you're in the right place. Let's get into it. To truly understand where Bitcoin and Ethereum are headed, we have to start with the biggest picture possible. Forget the charts for a moment, forget the technical analysis. We need to talk about the ocean that all assets, including crypto, are swimming in. And that ocean is global liquidity. Part 1. The global liquidity cycle, the everything code. There's a concept often called the everything code, which was popularized by macro investor Raoul Pal. The core idea is simple but profound. The business cycle, and by extension, the cycle of all major asset classes, is driven by the ebb and flow of global liquidity. Think of it like a massive tide. When the tide of money comes in, it lifts all boats: stocks, real estate, and yes, crypto. When that tide goes out, assets fall. The best way to measure this tide is by looking at the global M2 money supply. This is essentially a measure of all the easily accessible money in the world's major economies. And in 2025, the story of M2 has been one of sustained, powerful expansion. As of the third quarter of 2025, the global M2 money supply has surged to approximately $123.3 trillion. To put that number in perspective, it started the year around $105 trillion, and some analysts are even forecasting it could exceed $127 trillion by the end of this year. So why does this matter? When governments and central banks create more money, that money has to go somewhere. In an environment of low to moderate interest rates, holding cash becomes unattractive, so this new liquidity seeks a return. It flows into financial markets, pushing up the prices of scarce assets, and what is more provably scarce than Bitcoin with its hard-coded cap of 21 million coins. This isn't a theory, it's an observable phenomenon. Historical data shows an incredibly high correlation between the growth of M2 and Bitcoin's price. More liquidity in the system eventually finds its way into crypto. There is, however, a lag. Money printed on a Monday doesn't just show up on crypto exchanges by Tuesday, it filters through the banking system into corporate and investor accounts and then gets deployed into riskier assets. This means the liquidity created a few months ago is only now beginning to exert its full force on the market. That powerful surge in M2 we saw earlier in 2025 is the fuel for price action we're seeing today, and likely what we'll see in the coming months. It's the hidden engine working silently in the background. Part 1b: the Fed's dilemma and the strong dollar headwind. But if there's so much liquidity, why hasn't the market gone completely vertical? Why are we still seeing these sharp pullbacks in periods of uncertainty? The answer lies in the second major macro force, the policy of the US Federal Reserve and the resulting strength of the US dollar. Throughout 2025, the Federal Reserve has been in a tough spot. After a series of rate hikes to combat prior inflation, the question has shifted to when and how fast they will cut. The Fed did lower rates earlier in the year, but Fed Chair Jerome Powell has been careful to manage market expectations. This uncertainty creates a powerful headwind for assets like Bitcoin and Ethereum. When the future of rate cuts is in doubt, or when the Fed sounds more hawkish than expected, the US dollar tends to strengthen. We measure this using the DXY, or the US dollar index, which tracks the dollar against other major currencies. A strong dollar is a problem for two reasons. First, Bitcoin is priced in dollars globally. When the dollar gets stronger, it takes fewer dollars to buy one Bitcoin, putting downward pressure on its price. Second, and more importantly, Additionally, a strong dollar signals a tightening of financial conditions, effectively sucking liquidity out of the global system. This creates the choppy, volatile environment we've been in. We have the massive tailwind of global M2 expansion pushing assets up, but at the same time, we have the headwind of a strong dollar and Fed uncertainty pushing them down. This is the macro battle defining the market right now. Every piece of economic data, every speech from a Fed official causes this tug of war to shift, leading to the price swings we see on the charts. Part 1, C, inflation's ghost and the digital gold narrative. The final piece of the macro puzzle is inflation. Even with the Fed holding rates relatively high, concerns about currency devaluation haven't disappeared. They've just gone underground, waiting for the right moment to pop back up. The massive increase in money supply we've talked about is, by its very nature, inflationary. It might not show up immediately in the official numbers, but it erodes the purchasing power of fiat currency over time. This is where Bitcoin's core value proposition shines: digital gold. It's a hedge against monetary instability. We saw a powerful example of this following the US presidential election. In the period of volatility that followed Donald Trump's victory, Bitcoin rallied, hitting a record high of over $75,000 as investors sought a safe haven outside of traditional systems. This wasn't just retail speculation. It was a clear signal that in times of geopolitical or economic stress, a growing number of investors view Bitcoin as a viable store of value. It's an asset that is decentralized, has a fixed supply, and can't be manipulated by a central bank or government. So, when we put these three macro forces together, a clear picture emerges. We have a massive inflationary wave of global liquidity, providing a powerful tailwind. We have the Fed's policy and a strong dollar acting as a volatile headwind. And we have the persistent narrative of Bitcoin as a hedge against the very instability these other two forces are creating. This complex interplay is the real story. It's why the market can drop 10% one week and rally 15% the next. The daily price action is the symptom. These macro forces are the cause. If our thesis is correct, that the crypto market is being driven by this tug of war between global liquidity and Fed policy, we should see evidence on the blockchain. We need to look for the footprints of big players, the health of the networks, and the tech advancements that either support or refute our macro story. Part 2, A, the institutional wave. Reading the ETF tea leaves. The single biggest development of the last couple of years has been the arrival of spot Bitcoin and Ethereum ETFs. This was the moment traditional finance finally built a secure, regulated bridge into crypto. And initially, the flows were astronomical, confirming massive pent-up demand. However, recent data tells a more nuanced story that perfectly reflects the macro battle we just outlined. For instance, institutional ETF flows have become a high-frequency barometer of sensitivity to macro data. One day can see hundreds of millions in inflows when signals suggest easier financial conditions, while the next can see massive outflows if the market grows fearful ahead of inflation data or bond auctions. These flows are the footprints. They show us that institutional capital is here, the plumbing is built, but the faucet is now being turned on and off by the Federal Reserve and the bond market. The narrative has shifted from "are institutions coming" to "what will it take for the institutions that are already here to deploy their full weight?" The answer is macro clarity, part 2. B, Bitcoin, the halvings echo and underlying network strength. Beyond ETFs, we have to look at Bitcoin's internal economy. The most significant event in Bitcoin's code is the halving, which happened back in April 2024. This pre-programmed event cuts the new supply of Bitcoin in half. It is the engine of Bitcoin's scarcity and its digital gold story. The effects of the halving aren't immediate. It's not a switch that flips the price overnight. It's a slow, grinding supply shock. Every day, less new Bitcoin is created. As demand grows or even just stays constant, this dwindling new supply puts relentless upward pressure on the price. We are now in the phase where the echo of that supply shock is beginning to reverberate. And while the price has been volatile, the underlying on-chain metrics show a network that is fundamentally strong. Even as prices dip, metrics like the number of active addresses and the hash rate have remained robust, showing strong user and miner participation. This tells us that the long-term conviction of the network's core participants is unshaken by short-term price moves. Even more telling is that while smaller retail investors are panic selling, on-chain analysis shows large holders are accumulating. This is a classic transfer of assets from weak hands to strong, patient hands. Part 2, C, Ethereum, the Pectra upgrade and the L2 revolution. Now let's turn to Ethereum. While Ethereum is also heavily influenced by the macro environment, its value proposition is different. It's not just digital gold, it's a decentralized world computer, a platform for a new generation of finance, or DeFi. For Ethereum, technological progress is a primary driver of value, and 2025 has been a landmark year for that, centered around the Pectra upgrade, which began its phased rollout. Pectra was a massive undertaking, combining two major upgrades, Prague and Electra, to deliver a host of crucial improvements. For the average user, the impact is direct: lower transaction fees and faster confirmations. This addresses one of the biggest criticisms of Ethereum, that it was becoming too expensive and slow. By making the network more efficient, Pectra has made it cheaper to interact with DeFi, NFTs, and blockchain games, which is critical for driving wider adoption. For developers and stakers, the upgrade allows for much more efficient staking, for example, by increasing the max stake for a single validator from 32 ETH all the way to 2048 ETH. It also brought huge advancements in account abstraction, a feature that basically gives regular user wallets the powers of a smart contract, opening the door for user-friendly features like gasless transactions and social recovery. The Pectra upgrade solidifies Ethereum's position, but the true scalability story is happening on Layer 2 solutions, or L2s. These are blockchains built on top of Ethereum that handle transactions quickly and cheaply. Looking at Ethereum's mainnet transaction count alone is like only counting interstate highways and ignoring all the city streets. It misses most of the activity. This progress creates its own fundamental demand for ETH. But how does it stack up against Bitcoin? For this, we look at the ETH/BTC ratio, a key barometer for the crypto market. When it's rising, it signals altcoins are outperforming Bitcoin. Recently, the ratio has shown signs of life, bouncing from its lows, with some analysts believing this could be the start of a major altcoin surge heading into 2026. However, Ethereum also faces greater uncertainty. Its complexity and central role in DeFi invite more regulatory scrutiny, and it faces rising competition from newer blockchains. We're about to dive into the biggest wildcard of them all: regulation. This is the one force that could override everything we've just discussed. If you're getting value from this deep dive and want to stay ahead of these major market shifts, take a second to hit that subscribe button and turn on notifications. We cut through the noise and deliver this level of analysis every week. Your support helps the channel immensely. All right, let's talk about the elephant in the room. So we have the macro engine and the on-chain footprints, but there's one external force that can be a massive catalyst or a devastating roadblock: regulation. For years, crypto has operated in a gray area. In 2025, that is rapidly changing. Governments are no longer asking if they should regulate, but how. Part 3, A, the US conundrum. Clarity for Bitcoin, questions for Ethereum nowhere. Is this regulatory battle more important than in the United States? The approval of spot Bitcoin ETFs was a landmark victory, but the regulatory story recently took a much more constructive turn. In a series of announcements in mid-November 2025, the SEC, under new Chairman Paul Atkins, has begun working with Congress on a comprehensive framework for digital assets. This is a monumental shift away from the previous era of regulation by enforcement. Chairman Atkins, in a speech at the Federal Reserve Bank of Philadelphia, outlined a new initiative called Project Crypto. Crucially, he announced the SEC is working to establish a token taxonomy to draw clear boundaries. He explicitly stated that in his view, digital commodities, digital collectibles, and functional network tokens are not securities. Tokenized securities, however, would remain under the SEC's purview. This is the clarity the industry has been begging for. This move aligns with bipartisan legislation in Congress that would give the Commodity Futures Trading Commission, CFTC, primary jurisdiction over digital commodities. This is incredibly bullish for Bitcoin, as it all but solidifies its status as a digital commodity. But what about Ethereum? While the new framework suggests the ETH token itself may be treated as a commodity, its vast ecosystem of staking and DeFi could still face scrutiny as investment contracts. So the US appears to be moving towards split jurisdiction: the CFTC for the assets and the SEC for the financial activities built on top of them. This provides immense clarity for Bitcoin, but leaves Ethereum in a more nuanced position. Part 3B, the global chessboard. Europe's MICA, Asia's ambition, and beyond. While the US story is one of evolving clarity, Europe has taken a different path. comprehensive, unified regulation. The Markets in Crypto Assets MICA framework, which came into full effect at the end of 2024, is arguably the most significant piece of crypto legislation in the world. MICA creates a single set of rules for all 27 European Union member states, establishing clear licensing requirements for crypto service providers and strong investor protection rules. The impact has been immediate and profound. By the first quarter of 2025, over 65% of EU-based crypto businesses had already achieved MiCA compliance, and the number of registered service providers in the EU had skyrocketed by 47%. This regulatory clarity gave institutions newfound confidence, with 32% of institutional investors in the EU reporting they increased their crypto holdings specifically because of MiCA's protections. MiCA has transformed Europe from a fragmented market into a unified, regulated, and highly attractive hub for digital assets. Meanwhile, Asia presents a more fragmented but equally dynamic picture. Jurisdictions like Hong Kong and Singapore are actively competing to become innovation friendly hubs. This global regulatory landscape is no longer a monolith. It's a complex chessboard where major powers are pursuing different strategies. This reduces the risk of any single government derailing the industry and fosters competition to create attractive, clear rules. The wild card of regulation is slowly being tamed. So let's bring it all together. What have we found? We found that the chaotic daily price movements of Bitcoin and Ethereum are not random. They are the surface level effects of a few immensely powerful currents. The core thesis is this: the crypto market is currently defined by a conflict between a massive inflationary wave of global liquidity and the deflationary pressure of a strong US dollar, orchestrated by the Federal Reserve. For Bitcoin, the path forward is shaped by this conflict. The bullish case is powerful. We have the ongoing supply shock from the April 2024 halving, the enduring digital gold narrative, and the institutional plumbing is now fully built via spot ETFs. The on-chain data supports this, showing long-term holders accumulating from panicking sellers. However, the risks are real and mostly macro-driven. A surprisingly hawkish Fed or a spike in the dollar could act as a serious short-term break on the market. As of mid-November, Bitcoin is hovering around the $95,000 level after a sharp correction from its all-time high of about $126,000 earlier in the year. Technical analysts are watching key support levels closely. A decisive break below this zone could signal a deeper correction, while a strong rebound would reinforce the long-term uptrend. The key takeaway is that Bitcoin has graduated. It is now a macro asset, dancing to the rhythm of global finance. For Ethereum, the story is one of both macro sensitivity and technological destiny. The bullish case is rooted in its explosive utility. The Pectra upgrade in 2025 has made the network fundamentally more usable, and its layer 2 ecosystem has unleashed its scalability. Some analysts are extremely bullish, pointing to a strengthening ETH/BTC ratio and predicting Ethereum could significantly outperform Bitcoin in the next phase of the cycle. Some speculative high-end targets have even reached as high as $15,000, though this would likely depend on a massive rally in Bitcoin itself. The risks for Ethereum, however, are more complex. Its very utility invites greater regulatory scrutiny than Bitcoin. It also faces relentless competition. Ethereum's price, currently around $3,200 after recent volatility, reflects this tension. Analysts see the $3,000 to $3,200 range as critical support. Holding this level is crucial to avoid a deeper correction. The ultimate test for Ethereum is whether its incredible technological momentum can overcome these headwinds. So, what's the key trend to watch? It isn't the daily price. It's the powerful interplay between macroeconomics, on-chain adoption, and regulation. Stop watching the 1-hour chart and start watching the global liquidity cycle. Pay attention to the language of the Federal Reserve and track the progress of global regulation. That is where the real trend is being set. Those who understand this new reality will be prepared to navigate the volatility and capitalize on the opportunity ahead. Those who don't will be shaken out by the noise, missing the true signal. What do you think is the biggest driver for the next 6 months? Is it the Fed, the halving's echo, or the Pectra upgrade? Let me know your thesis in the comments below. And if you found this analysis valuable, please hit that like button and subscribe for more deep dives that go beyond the headlines. Thank you for watching.